An old friend stopped by the office today, hadn't seen him in years. One of the things he asked me, what do you guys do around here? Well, one of the things I told him is that we solve a lot of the problems that the investment industry tends to cause. Now, a lot of people know the rules of investing, I told him. You think about it. You buy low, sell high, diversify your portfolio, buy and hang on to things, don't try to time the market. But what happens is the investment industry routinely breaks these rules, and I'll explain why in just a second. Now, the example I gave him of how this happens, I used a particular fund company's mutual fund that's used in a lot of retirement plans. It's called the Fidelity Freedom 2040 Fund. It's a fund that's designed to be bought for that person that's retiring in 2040. Now, I don't mean to pick on Fidelity because a lot of fund companies, most fund companies, in fact, engage in a lot of the activities that I'm about to talk about, but I thought I'd use it as an example. Let's take a look at how the fund's put together and what happens inside of the mutual fund. What you're looking at is a program that tracks all of the major mutual funds. Now, right here you see the Fidelity Freedom Fund. Open that up, and one of the things you'll notice right away is that this fund is a fund of funds. It owns 24 Fidelity mutual funds, funds that Fidelity has picked out to be in this particular mutual fund. Now, if I wanted to see exactly what funds are in there, I could go up to this view and open up the complete fund holdings, and there are all the funds that are inside this mutual fund. Now, let's just focus on the top 5. The Fidelity Series Large Cap Value Fund is one of the funds, the Series All Sector Equity, Disciplined Equity, Growth Company, and Series 100 Index. To see how one of the rules of investing is being broken, let's open up what is called a stock overlap analysis. What this is showing us right here is the different funds and the stocks that they hold. One of the things you'll notice right here is that ExxonMobil Corporation is the largest holding in these funds in general. And all 5 of those funds, the top holdings in that fund of funds, hold that one stock. Apple is held by 3. JP Morgan Chase holds 5. All 5 funds hold that stock, and Chevron is held by all 5, and Microsoft. This is called stock overlap. So basically the rule of investing being broken here is, of course, diversification. Why would we want to have funds that own the same exact stocks in the investment portfolio to such a large degree? If we dig down into one of the holdings, for example, the Disciplined Equity Fund, we see another rule of investing being broken, and that's buy and hang on to things. What you see right here is that this fund had a 200% turnover rate. In other words, the stocks were changed twice in a calendar year according to Morningstar. Not a process that we want to engage in. We want to buy and hang on to things. And what we see as a result of that is that the fund has underperformed its benchmark, or the area of the market that it's investing in virtually every time period over the last 15 years. We see that's also the case with the Fidelity Large Value Fund. There's 171% turnover, quite a high amount of buying and selling going on inside of the fund. The result of that turnover is, of course, it's a different benchmark or a different area of the market that the fund's investing in. It's trying to compete against the Russell 1000 value. That's a specific area of the market. And you see that in the 3-month, 12-month, 3-year, 5-year, the performance, you see 3 years, it's underperformed the market by 2.54% per year. That's a significant amount of underperformance that's happening here. Now back to the main fund page right here, the Fidelity Freedom Fund. If we open up that fund, we see what the result is of all these rules being broken. Number 1, you see that blue line up there. That's just a fairly well diversified portfolio, not perfectly well diversified or the way I'd like to diversify, but what you notice right away is the red line is the Fidelity Fund, and the blue line is a better diversified mix. And you see that from about late 2000 until right now, you see that the fund has significantly underperformed what a better diversified mix that followed some of these rules of investing would have done. So usually the next question that comes up is this: why is it that mutual fund companies, banks, and brokerage firms engage in this activity if studies show it doesn't work? Well, the reason, I believe, comes down to marketing. If you're a mutual fund manager and you're trying to attract money to your mutual fund, what you want to do is you want to try to beat your peers. Why? Well, because investors tend to change mutual funds every 3 years, and they tend to move to those funds that have had the best recent performance. it only makes sense that if this money is going to be in motion, you want to get some of it, you've got to beat your peers. Well, how do you do that? Well, typically what they do is they engage in stock picking and market timing, trying to pick the best stocks and trying to time the market so that they can beat their peers. The problem is that a fund that has done well in the past doesn't necessarily repeat its performance in the future. Matter of fact, very few funds actually repeat their great performance into the future. But the public doesn't know this. So what happens is the mutual fund companies are given great incentives to gamble, as I would call it, with people's money to try to beat their peers. So what's our job? Well, our job is we're what's called a registered investment advisor. In other words, when we work with clients, we have a fiduciary responsibility. In other words, we've got to keep their best interest at heart. And we also don't get paid by the mutual fund company, so we don't have an incentive to recommend one fund company versus another. So it's a great question, and thanks for asking. It was asked by somebody that doesn't normally watch these videos. So keep the questions coming, and we'll catch you next time.